There's a metal. Most people never think about that's currently at the center of a market structure so unusual, so fundamentally broken, that when it finally cracks, the ripples will reach into every corner of the global economy. And here's the thing, it's already cracking. Right now. While you're watching this, we're talking about silver, not the silver your grandmother kept in a drawer, not the silver traders hype on Reddit. We're talking about the physical metal that makes solar panels work, that conducts electricity in every electric vehicle, that sits inside the data centers powering artificial intelligence. And there's a mathematical problem developing that has nothing to do with speculation and everything to do with physics. The world is running out of this metal faster than new supply can possibly arrive, not in some distant future. Right now, the data is screaming it. But here's where it gets strange. The financial markets that trade silver don't seem to care. Or more precisely, they're structured in a way that makes them physically incapable of responding to the reality unfolding in the physical world. Futures traders, hedge funds, and investment banks are playing a pricing game that is increasingly disconnected from the actual availability of the metal itself. And when those two realities collide, when paper markets meet physical constraints, we get what's happening right now. Violent price swings that look like chaos, but are actually the market's way of screaming that something fundamental has broken. Consider what just happened. Silver hit an all-time high, then collapsed by more than a quarter in a single trading session. The mainstream narrative calls it profit-taking, a natural correction after a massive run-up. But the actual data tells a completely different story. While prices were crashing, the largest commercial traders, the ones with physical metal in warehouses, weren't selling. They were covering short positions. Industrial consumers weren't pulling back orders. They were accelerating purchases, terrified of supply shortages. The drop wasn't driven by fundamentals deteriorating. It was driven by the mechanical unwinding of a positioning structure that had become unsustainable. This matters because silver isn't just another commodity. It sits at the intersection of three massive global forces that are all accelerating simultaneously. First, the energy transition. Every solar panel requires silver paste to conduct electricity. No substitutes exist at scale. Second, the electrification of transportation. Electric vehicles use twice as much silver as combustion engines. Third, the artificial intelligence revolution. Data centers require massive electrical infrastructure, and silver's conductivity makes it irreplaceable in high-performance applications. These aren't trends that reverse. They're structural shifts baked into government policy, corporate strategy, and technological reality. Now layer on top of that the strange way silver gets produced. Unlike gold, which comes from dedicated gold mines, 70% of silver comes as a byproduct. It's extracted as a side effect of mining copper, lead, and zinc, which means when you need more silver, you can't just open more silver mines. You need someone to want more copper, more lead, more zinc. And if they don't, silver production stays flat no matter how high prices rise. It's a structural bottleneck that has no solution on any time frame that matters. To understand how we got here, we need to go back to the moment when this structural imbalance started building, because that's where everything changed. The silver market has always been weird. For most of human history, it was money, coins, currency, the actual physical manifestation of value. Then in the 20th century, it became industrial. Photography consumed vast quantities, then electronics, then solar. Each transition left behind a market structure that never quite caught up to the new reality. But the real turning point came in the past decade, when governments around the world started making commitments they didn't fully understand. Net zero carbon emissions by 2050, renewable energy targets, electric vehicle mandates. These weren't suggestions. They were legally binding commitments that required massive infrastructure buildouts. And every single one of those buildouts required silver. The solar industry became the clearest example of this dynamic. A typical solar panel uses roughly 20 grams of silver. That doesn't sound like much until you scale it. Global solar installations have been growing exponentially, driven by subsidies, mandates, and the simple fact that solar has become the cheapest form of energy in most markets. In 2024, solar installations consumed approximately 120 million ounces of silver. By 2030, that number is projected to more than double. The International Energy Agency's models show solar capacity increasing from roughly 1 terawatt today to over 5 terawatts by the end of the decade. Do the math. That's hundreds of millions of additional ounces of silver that need to come from somewhere. And here's the problem. Somewhere doesn't exist. Global silver mine production sits at roughly 830 million ounces per year. That number has been basically flat for the past 5 years. It's not growing. In fact, in some years it's declining. Meanwhile, total industrial demand crossed 680 million ounces in 2024 and keeps climbing. The deficit, the gap between what gets mined and what gets consumed, hit roughly 150 million ounces. That gap gets filled by existing inventories, stockpiles that have been built up over decades, except those inventories are now running low. The London Bullion Market Association, which tracks physical holdings in major vaults, has seen deliverable inventories decline sharply. Exchange warehouses that once held hundreds of millions of ounces now hold fractions of that. And here's where the transmission mechanism starts to matter. When physical inventories get tight, something called backwardation occurs. That's when the price of immediate delivery exceeds the price of future delivery. It's the market's way of saying, we need metal now, and we're willing to pay a premium to get it. Backwardation is rare in commodity markets. It signals stress. And in silver, it's been appearing with increasing frequency, suggesting that the physical shortage isn't a future problem. It's a current problem that's getting worse. If you're starting to see the pattern here, if this is already reshaping how you think about commodity markets and how supply constraints actually work in the real world, do me a favor, hit that like button and subscribe. Because what's coming next is going to take this even further. We're going to look at who's on the other side of these trades and why their positions are becoming impossible to maintain. The natural question is, why don't mining companies just produce more silver? And the answer reveals everything about how broken this market structure really is. Because of that byproduct problem, silver production is tied to metals that are experiencing their own market dynamics. Copper, for instance, is currently trading in a range where new mine development is barely economic, after factoring in permitting delays, environmental restrictions, and capital costs. Developing a new mine takes 7 to 10 years minimum. Even if companies started today, new supply wouldn't arrive until the 2030s, by which point the cumulative deficit could exceed 1 billion ounces. Recycling can't save you either. Silver recycling rates are already near maximum efficiency. The metal that can be economically recovered from old electronics, old solar panels, old industrial applications is already being recovered. There's no massive untapped source of recycled silver waiting to flood the market. But here's what the industrial users didn't anticipate, and neither did the financial markets. The consequences of these structural constraints are already playing out in ways that can't be reversed. What the public sees is price volatility, wild swings that look irrational, that financial media attributes to sentiment, to speculation, to technical trading patterns. What's actually happening is a lot more mechanical and a lot more dangerous. The silver futures market is where price gets discovered. Contracts traded on exchanges like COMEX represent obligations to deliver physical metal at specific dates. But here's the critical detail. Most of these contracts never result in actual delivery. They're cash settled. Traders buy and sell paper claims on silver without ever touching actual bars. This works fine when everyone trusts that physical metal would be available if they actually demanded delivery. But when that trust starts to erode, when market participants begin to suspect that there isn't enough physical silver to back the paper claims, the entire structure becomes unstable. The Commodity Futures Trading Commission publishes weekly reports showing who holds what positions. The data from earlier this year revealed something extraordinary. Commercial traders, the category that includes actual producers and industrial consumers, had dramatically reduced their short positions. Short positions are bets that prices will fall. Producers typically hold shorts as a hedge against the metal they'll eventually mine and sell. When they start covering those shorts, buying back those positions, it signals they expect prices to rise, or more precisely, that they expect physical tightness to make holding short positions too risky. At the same time, managed money, the category that includes hedge funds and speculative traders, had built up significant long positions. Long positions are bets that prices will rise. The setup was classic. Commercials betting on higher prices, speculators betting on higher prices, and declining inventories providing fundamental support. Then came the catalyst that triggered the unwind. A political appointment, a signal about potential changes to monetary policy, the kind of headline that in normal markets might cause a modest pullback. But in a market structured like silver, where positioning had become extremely one-sided, where leverage had built up across the system, it triggered a cascade. Speculators who had borrowed to buy silver suddenly faced margin calls. They were forced to sell, not because fundamentals changed, but because their brokers demanded more cash to back their positions. Those forced sales pushed prices lower, triggering more margin calls, forcing more sales. A feedback loop that had nothing to do with supply or demand for physical metal, and everything to do with the mechanics of leveraged paper trading. The commercial traders who had covered shorts earlier were proven right, but not in the way anyone expected. The violent sell-off created an opportunity. With prices down sharply and speculators flushed out, the physical reality reasserted itself. Industrial users stepped in to lock in supply. The deficit didn't go away. The structural shortage didn't get solved. The paper market just had a mechanical reset. But here's the deeper mechanism that most analysis completely misses. While everyone was focused on the price chart, on the dramatic intraday swings, the actual power dynamics in this market were shifting in a way that's basically irreversible. The entities that control physical metal, the miners, the refiners, the industrial consumers with stockpiles, they're starting to understand they have leverage, real leverage, not the financial kind. the kind that comes from controlling a physical resource that other people desperately need and can't get anywhere else. When commercial traders flip from net short to flat, when producers stop hedging future production, it's a signal that they're expecting supply constraints to persist, that they're willing to hold metal rather than sell it forward at today's prices. And when that behavior scales across the industry, when multiple producers make the same calculation simultaneously, the available supply that hits the market shrinks even further. The deficit widens, the tightness intensifies. And if you think that's the full story, you're not even close, because what happened next is what really matters. The financial system is starting to realize it has a problem it can't solve with more credit, more derivatives, or more paper contracts. So here's what all of this means. We're watching the slow motion breakdown of the paper to physical pricing mechanism in a critical commodity market, not in some distant future. Right now, the evidence is already visible in the data. Lease rates, the cost of borrowing physical silver, have spiked to levels not seen in decades. When lease rates rise, it means holders of physical metal are demanding higher compensation to lend it out. That behavior doesn't emerge unless they believe the metal is scarce, valuable, and likely to become more so. Banks and swap dealers who sold short futures contracts, betting they could deliver physical metal if needed, are discovering that physical metal isn't as available as they assumed. They can't simply call up a refinery and order a few million ounces. The refineries don't have it. The vaults don't have it. The only source is buying it on the spot market, which pushes spot prices higher, which makes their short positions more expensive to maintain. This creates a self-reinforcing dynamic. As shorts cover, buying pressure increases. As buying pressure increases, physical tightness becomes more visible. As physical tightness becomes more visible, more entities rush to secure supply before it gets worse. The industrial users who need silver for manufacturing can't afford to wait. They need metal in 3 months, 6 months, a year. So they start forward buying, locking in supply ahead of time. That forward buying removes metal from available inventory even before it's needed, tightening the market further. The monetary policy angle makes this worse. The United States federal debt now exceeds 130% of GDP. Deficits are running over $2 trillion annually. The Federal Reserve is trapped between two impossible choices: raise interest rates to fight inflation and risk triggering a recession, or keep rates low and allow inflation to persist. Either scenario creates conditions favorable for hard assets. Higher rates increase recession risk, driving safe haven demand. Lower rates destroy the purchasing power of currency, driving inflation hedge demand. Silver, with its dual role as both industrial commodity and monetary metal, benefits from either outcome. Central banks globally are diversifying reserves away from dollar dominance. Gold purchases have been running at record levels. But silver offers something gold doesn't: industrial utility. A central bank or sovereign wealth fund buying silver isn't just making a monetary bet. They're securing access to a metal critical for domestic industrial production. Russia has already signaled interest in building silver reserves. Other nations will follow once they realize the strategic implications. Think about the incentive structure from an emerging market government's perspective. You're trying to build domestic solar manufacturing, electric vehicle production, advanced electronics. You need silver. You can either buy it on international markets at whatever price Western financial institutions decide, or you can accumulate physical reserves now while prices are relatively suppressed, ensuring your industrial base has access to metal regardless of future market conditions. The second option looks increasingly rational. So here's what I want you to think about if the industrial demand projections are even close to accurate. If solar installations continue growing, if electric vehicle adoption continues accelerating, if data center buildouts continue expanding, where does the additional silver come from? Mines can't increase production fast enough. Recycling is maxed out. Inventories are depleting. The math doesn't close. Something has to give. Either demand gets rationed through higher prices, or industrial projects get delayed because metal isn't available. Drop your take in the comments because, honestly, I'm curious where you land on this. Is there a supply response I'm missing, or are we really heading into a situation where physical constraints force a complete repricing? And this is where it gets personal. Because what I'm about to show you isn't happening to some abstract economy or distant market. It's happening to you. Right now, every device you own, every infrastructure project your tax dollars fund, every element of the energy transition politicians promise, it all depends on continued access to silver at prices that make those technologies economical. If silver reprices significantly higher, the cost of solar installations increases. The cost of electric vehicles increases. The cost of grid infrastructure increases. Those costs get passed through to consumers, to taxpayers, to anyone participating in the economy. The structural shortage in a metal most people never think about becomes a constraint on the economic future everyone assumes is coming. So, where does this leave us? We're standing at a moment where the physical world and the financial world are telling contradictory stories. The physical world says there isn't enough silver to meet demand. The financial world says prices can be managed through derivatives, through paper contracts, through the normal mechanisms of futures markets. One of these perspectives is going to be proven correct. The other is going to be proven catastrophically wrong. The pattern we're seeing in silver isn't unique. It's happened before in other commodity markets when structural deficits met financial engineering. The result is always the same. Eventually, physical reality wins. Paper contracts are worth exactly nothing if there's no physical metal to deliver against them. Traders learn this lesson painfully. Industrial users learn it through supply disruptions. Policymakers learn it when critical infrastructure projects stall. But here's what makes this particular situation different. Silver isn't just a commodity experiencing a temporary supply squeeze. It's a critical input for the technologies that define the 21st century economy. The energy transition isn't optional. It's mandated by law in most developed economies. The electrification of transportation isn't a trend that might reverse. It's backed by billions in subsidies and regulatory requirements. The artificial intelligence build-out isn't slowing down. It's accelerating. All of these forces require silver, not want it, require it, and the supply isn't there. The most likely outcome over the next several years isn't a return to stable, predictable silver prices. It's increasing volatility as the market oscillates between paper-driven sell-offs and physical-driven rallies. Each cycle will expose more participants to the underlying reality. The metal is scarce, becoming scarcer, and there's no solution arriving in any time frame that matters. The industrial users who understand this will act rationally. They'll secure supply ahead of time, accepting higher prices today to avoid unavailability tomorrow. That behavior will accelerate the very scarcity they're trying to hedge against. Financial markets will adapt, eventually. Derivatives will be restructured, contract specifications will change, delivery mechanisms will be modified. But that adaptation won't create more physical silver, it will just redistribute who gets access to the available supply. The entities with the strongest balance sheets, the longest time horizons, the most strategic need will outbid everyone else. The marginal users will get priced out. Projects will be redesigned to use less silver or delayed until substitutes can be developed or canceled entirely. Governments will eventually intervene, probably. Strategic reserves might be established. Export restrictions might be imposed. Domestic production might receive subsidies. But all of that takes time, requires political will, and competes with 1,000 other priorities. Meanwhile, the deficit continues widening, the stockpiles continue depleting, the mathematics continue not working. If there's one thing you take away from this, let it be this. Commodity markets aren't abstract financial constructs. They're mechanisms for allocating physical resources in a world of constraints. When those constraints tighten, when physical limits assert themselves, prices don't just rise modestly, they gap, they spike. They move in ways that seem irrational until you understand they are the market's way of rationing scarcity. Silver is approaching that moment. Maybe we're already in it. The violent price swings we've seen recently aren't aberrations. They're symptoms of a market structure breaking under stress it was never designed to handle. The question isn't whether silver reprices higher from here. The question is how disruptive that repricing will be, how many projects get delayed, how many assumptions about the energy transition prove unworkable at scale, and whether policymakers recognize the constraint before it becomes a crisis. Because nothing about this is hidden. The data is public. The deficit is documented. The supply constraints are well understood by anyone who looks. What's missing is the collective acknowledgement that this matters, that a shortage of an industrial metal most people never think about could become a bottleneck for the economic future we've been promised. The market will force that acknowledgement eventually. Price is the signal that can't be ignored. When solar manufacturers can't secure silver at economical prices, when electric vehicle producers face supply disruptions, when grid infrastructure projects budget for metal that isn't available, the constraint becomes undeniable. We're not there yet, but we're closer than most people realize. Watch what the commercial traders do. Watch where inventories flow. Watch whether lease rates stay elevated or spike further. Those signals will tell you whether this is a temporary squeeze or the beginning of a structural repricing that reshapes multiple industries. The data won't lie. Markets might, politicians will. But physical inventories either exist or they don't. And right now, they increasingly don't.